Welcome to another episode of Straight Talk on Stocks with Kevin Hurley, Managing Partner of Hurley Investments LLC, and Jeffrey Dunyan, CEO and owner of Safe Option Strategies. All right, Kevin, we're live. We were, before we went live today, Kevin and I were having a little offline conversation. Kevin, the markets are up, man. The Dow's up 178, the NASDAQ's up 116, getting close to 2% up. S&P up 1.25%, up 29, and you're in a pretty lousy mood today.
I am in a foul mood. We're going to keep this PG-13 today, I hope.
I'm not laughing at you. Well, yeah, I'm laughing at you, but not at what's going on. I'm laughing at your mood because you crack me up, but I'm not happy with what you told me is going on. So lay it out there, man. What's happening?
Here. The PPI inflation numbers were down negative 0.2 instead of negative 0.1. The core PPI, which needs to be up so that Powell won't raise rates and keep inflation in check, which has been non-existent, was down a negative 0.1, was supposed to be up 0.2. Empire Manufacturing 3.9 versus an expected 12.2. I've got my favorite New Yorker that gave me a call last night that let me know how easy it is to make money in the stock market. And that he's off to the races, which is funny because he had no idea JP Morgan was reporting today, that Wells Fargo is reporting today, and that they bombed their numbers.
You know,
that was awful.
They bombed, but I got to tell you, this is one of the things we were talking about.
They bomb their numbers, they bomb their guidance, but if Jamie Dimon can say something off camera on how good they're going to do next quarter, it all must be right. And
they turned it around
I gotta
today.
say, from someone that holds 65, like $8,000 worth of leap long call, January 20, $35 strike price, Bank of America contracts. I could control 6,500 shares of Bank of America. Yes, I appreciate it. I love it. I'm glad to see Bank of America come back. Hopefully it follows through to tomorrow. Bank of America gets back up to $28, $29. I'm most likely profitable, and I'll take half or 2/3 of my way over leveraged dollar cost average position in Bank of America, take a little profit, take some money off the table. But I'm frustrated, Jeff. I'm frustrated that people think this is easy, that it's so easy, yet they can't do basic fundamental research to know what's going on for a day or for the week. That people think if you just let it sit in the market, it makes money. And if, obviously they haven't pulled up a chart for 20 years. Didn't see 12 and a half years where the market was flat. In fact, I'm writing a white paper right now on why my portfolio hasn't quadrupled. If it had been with a big box, a Vanguard is who I like to pick on, where supposedly the market's up 146% if you go by averages. But if you just do real portfolio growth, you're at, like an 83% growth for the last 19 years. You haven't doubled your portfolio, let alone all the hidden fees that these big box places charge. Could you imagine being in the stock market for 20 years and not doubling a portfolio? And then I had, all due respect, I had the same idiot tell me, well, I've doubled it a couple times. Well, no, when you only put 25,000 in over the next 19 years, you put 75,000 more in for a 401k. You put in 100,000, it's sitting at 143,000. That's half of what the real growth has been over that 19-year period, you jackass. I can't believe people are so stupid. So save our podcast, because I'm just going to go. It's going in the toilet in my mind right now. Save us.
Okay. I'll go straight up positive right here. You are scratching your head a little bit and wondering how is it possible that JP Morgan misses its numbers, but Jamie Dimon makes some off-camera comments that get picked up, that get reported and circulated, and suddenly, I mean, look at this chart. They're suddenly they gapped down this morning. That's those two horizontal lines, that's yesterday's close, and that's this morning's open. Not a huge gap, not a massive gap, but they gapped down this morning. And since Jamie Dimon's comments, they have made their way back up. They're trading in positive territory. They're trading at the highest level they've been since the first week in December. They're right up there testing a level of resistance at 102. And I got to tell you right now, market sentiment is changing. When I was online with my students this morning for one of our live classes, the thing that I focused in on in my monologue there, and I'll repeat it here, is that sentiment is changing. I'm going to go to a chart of the Dow real quick because I think this is important for people to see this.
While you're doing that, JP Morgan misses profit expectations by 23 cents for the first time in 15 quarters, and they missed it primarily on their bond or fixed income selling. In all honesty, Wells Fargo was much worse all the way across the board. Netflix is a bright spot, but it's amazing how off camera Jamie Dimon can make a comment and he moved the market today. It's pretty amazing, pretty impressive. Talk to us about market sentiment, because I agree 100% with you.
He's a guy that has that ability. He's one of those people that has that ability to move the market. Here's the thing that I wanted to point out. You had a market sentiment from the early part of October. You had comments by the Fed that came back here about how they're tightening the balance sheet. They've got to raise rates to keep up with inflation. There was no evidence of inflation yet. There were projections of inflation. There's a huge difference. Evidence of actual inflation versus projections of inflation. And the Fed was trying to outguess themselves. They were trying to outthink themselves. And then what happened is his comments right back here, the comments by Jerome Powell, and we picked on this enough. I'm not going to beat up on Jerome Powell because he has at least partially redeemed himself a little bit in my eyes. Someone got to him, someone who is a better public speaker, someone who recognized that his comments were just straight up stupid, got to him, and he's redeemed himself somewhat. He's been more thoughtful in the things that he said. So, but right here, what he did, and this is what a lot of people don't realize, what he did was he changed the market sentiment. We were already in a market that was a little bit scared about rising interest rates, a little bit scared about slowing economic growth, a little bit scared about Chinese trade talk and Chinese rumors. You already had a market that was scared. And what he did was shift that market sentiment so that people in any piece of news, good or bad, you could spin it to the bad side. Any piece of news, you could spin it to the bad side, and people were looking for that reason to sell. And the sentiment was such that it carried over. It killed a rally in November. It killed a rally at the end of November, and we had the worst December in history ever, or was it the worst going back to the Great Depression years? I mean, this was one of the worst Decembers ever in the U.S. stock market. No Christmas rally, no Santa Claus rally. It was gone. So you've got this situation where sentiment was really off. The difference in this move right here, and it's still a young rally. It's right now, it's not a lot different on paper than what we got right here. Let me clear some of these marks and make more sense of this. For those of you that are just listening to the podcast, I'm circling the little rallies on the Dow Jones that we had at the end of October and the first week of November, the one we had at the very end of November, and then the one we've had most recently since the day after Christmas. On paper, they all look similar. The difference is on a number of occasions over these past 2.5 weeks, you have seen a buy on the dip instead of a sell the rally towards the end of a trading session. Yesterday, I really got worried that we were going to sell off and go back to the day lows of 225 down on the Dow. And I was pleasantly surprised that at one point in the last 5 minutes the market was open, you had one point in time where we were only down 38 or 39 points. And then there was just some computer trading, excuse me, honestly, in the last minute, there was some computer trading that took the Dow from being down 37 a share to being down 86. I look at being down 86 on a day that started with a 225 point drop, and I say people were buying the dip more than they were selling the rally. That only happens when there is a change in sentiment. People are starting to recognize what should and should not move the markets. They're starting to recognize that there are things going on in the periphery. There are things going on in your peripheral vision. The white noise is what I used to refer to it as. You got to learn to not pay attention to that, but you can't overcome herd mentality. When that's what everyone else is paying attention to, that's what's going to move the markets. And there's no getting around that. Sentiment is changing. Has it completely changed? Are we completely out of the woods? I'm not going to feel like we're completely out of the woods until we see the Dow break that 24,500, 24,750 mark. When the Dow is able to break above that, then I'm going to start believing that we could possibly get back to the all-time highs and could be on our way to a 27,000 point Dow Jones Industrial Average. We got to break a level of resistance, and sentiment has to continue to move back in favor of a recognition of the underlying fundamentals in the market. I did an exercise kind of for myself more than for anybody else, but you pick during this stretch right here from the first week in October to Christmas Eve, you pick any piece of news that came out, pick any piece of good news that came out, and I'll give you a negative spin on it. You pick any piece of bad news that came out, and I'll give you a positive spin on it. And it just, when sentiment changes, people start tuning out the negative spin on good news, and they're more willing to listen to the positive spin on bad news. What were those headlines that you threw out just a few minutes ago? What was the PPI numbers?
PPI numbers were a -2 versus a -1 expected, but the core one was the big one. -0.1 versus a +0.2.
Okay. So you can have one of two headlines. You can say PPI numbers give concern over more interest rate hikes. That could be a headline you could throw out there that just casts negative on that. Or you could say PPI numbers missed, but underlying fundamentals still strong.
Or what they will say, or they did say, is slowing inflation makes gas prices cheaper.
There you go. There you go. It's the news isn't any different. The actual numbers are not any different. It's the spin that you put on them. We had a whole conversation, and I've had this conversation with friends and family. I think we had one of these conversations on the air. There's a segment of people that just are desirous to give any piece of news. They want to give it their opinion. Most of the time it's political spin, but sometimes it's just their opinion on what's good or bad about it. The media no longer reports the news. The media tells you how you should interpret the news. I've seen that change in my lifetime. I've witnessed it. It used to be that you could turn on the news and you would get the information and the facts reported to you. In a seemingly same way, the news is presented with a slant. There's never a headline that is not slanted towards what they want you to think about it. They're predetermining where you should be by the way they write the headline. Instead of saying, here's the PPI numbers, there's the facts, here's the PPI numbers. PPI numbers, analyst expectations were here, PPI numbers came in here. They could stop right there, and that's news, that's facts, that's unobjective, or excuse me, that's objective. That's not subjective. That is objective news. That is simply giving you the facts. But whether it's liberal or conservative, whether it's bullish or bearish, whether it's hawkish or dovish, none of that matters. What they do is they say missed PPI numbers means inflation may go up, or missed PPI numbers give worry about inflation.
To create inflation. And he'll raise it 4 times this year for no reason, because he doesn't know what the hell he's doing, because he's out of touch with the stock market, real life.
But no matter what, the point I'm making is, no matter who is writing the headline, journalists no longer recognize in many cases, or no, and there are plenty of times where, especially politically, where it's very deliberate, where the way they put the headline is a deliberate attempt to slant it towards their politics. That's their entire goal. You can't get away from that. Most of the mainstream media does that. But when you're talking non-politics, when you're talking market stuff, I think there are journalists who unknowingly write a headline that fits their narrative. They think they're being objective. They think they're just giving you the news story. They think they're just presenting facts, but it's like a lost art that you can present information without skewing it towards a belief system or a thought pattern that you want or that you have. It's really, I hate, and I can't emphasize the word strongly enough. I hate headline driven markets, but it has become the reality. I don't know that it will ever go away. We have to learn how to trade and have to manage headline driven markets. And we have to recognize that based on who we're getting the headline from and how influential they are, whether we agree with it or not, we got to be able to react to it. CNBC,
Can I jump in really quick?
Yeah, jump. Well, of course. Sorry, I don't
want
mean
to
to dominate.
people use common sense. That's what bugs me today. I've had some amazing conversations with some amazing people this time of the year when most people are looking at their portfolios and saying, all right, didn't do as well as I thought I would. My broker misled me on some things. I've got one poor guy that thought he had artificial intelligence and then he was up, or actually it's a gal that thought she was up 20% and she was down 10%. And I look at some of these people and say, you know the market's down. You know you're in a buy and hold scenario. Where is the common sense to understand that things aren't going to go the way you think? Things can't mathematically go the way you want them to go if the numbers don't add up. And it's simple addition and subtraction. I was shocked when I had to point out to this lady, no, you're not up like 22% like you think you are. You're actually down 10% and you missed the market that was down 6.6. No, artificial intelligence is nothing more than a fancy word for a computer algorithm that does not predict the future. That does not mean you're always profitable. That means you've got a fancy, for all intents and purposes, a fancy stock screener that will calculate more than the average stock price or stock movement for a day. And you've got to, where's the common sense where people think a computer algorithm will predict the future, where there's some type of artificial intelligence that's really just a stock screener that can pick every stock that will always make money? Where's integrity for a financial advisor to let someone think she's up 22% when she's down 10? That's a 32% difference on her account. For simple math, she thought she had $100,000 more than she had, which when you do the calculations, imagine if you have a $350,000 account that's really only $250,000 and you're trying to budget your next 15 years of life with health issues and Medicare payments. It's wrong. It pisses me off.
Okay, so
let me in the foul mood that I'm at today when I really think common sense solves 99% of these issues.
Okay, let me ask you a question, because we've got people that listen to this that have probably found themselves in a similar situation. How does a broker do anything that could lead you to believe that you've got a profit when you don't? And let me maybe phrase it in this way. You're kind of implying that this individual needs to exercise some common sense, but how do you open your account and think you're up $100,000 when you're down? How does that happen?
Maybe that's it. Maybe you need to open up your account. Maybe you need to open up and look at your statements on where you were at the beginning of the year, where you're at right now. Maybe you need to be taught or not misled. And when you are misled, maybe you need to find the balls to report someone to the Securities and Exchange Commission and get it stopped. I'm
Okay, but
shocked at what some of the people get away with in my industry, and it's just outright wrong.
okay, but in the absence of in okay, so let's say I don't know how a person has money invested in the market and isn't looking at a statement and figuring out where it's at. But for argument's sake, um, let's say uh, let's say hypothetically, I don't even know how to phrase this question because I don't know how an individual can
Could be that way,
believe that
right?
they're up. I can't understand how an individual. I'm going to ignore that comment. I don't know how an individual can believe that they're up in their portfolio when the balance is down. And if you're not looking at your portfolio, what would make you think you're okay? So you're not looking at your portfolio, but what
So,
information are you getting to make you think you're up?
so you get an email that states how well a firm is doing without looking at your statements. You look at your statements and you're misled to here is your purchase value. And because we're doing so well, you don't need to look at this value, which is your live value or your market value. You also are told or misled by way of, well, your bonds are down, but they're not really down if you stay in them for the next 20 years because you'll get back your full $1,000. Well, yes, they're down. That doesn't mean you have to take a loss. It's a paper loss. But if you needed that money today, you'd have to liquidate a bond that is down that you will
Okay.
take a loss on. And to be told, well, if you wait, your full time, your length, your vested period, you'll get your $1,000 back. It's just wrong. It's you know what?
So what it
I am in
is,
an industry where I am disgusted with the lack of integrity that you see from a
well,
broker.
what you're okay, so here's then the scenario for our listeners that and I know 99% of our listeners would never be in this position. You get you get an email or you get something in the mail where I'm not even gonna I'm not even gonna throw out a broker's name, but let's say Fidelity because I don't like them. So Fidelity, you've got all your money with Fidelity, and they send you a statement, and you're not and you've got all these numbers across the top of the statement, and one of these numbers is your actual account value that is reflective of where you would be if you liquidated open positions right now. Here's what the portfolio is worth if you just closed everything, whether it's up and you're closing it for a profit, whether it's down and you're closing it for a loss. Here's where your account is at if you liquidate it right now. And people are skipping past that, and they're seeing what their buying power is, basically, for lack of another word. They might have some money froze up in a option requirement. They might have a position that's down, but they haven't booked the loss. They might have margin available to them that they're unaware of or they are aware of. And so they get a line that's basically however it's worded, is like their buying power. And a lot of people that are actually active in the market, they don't understand every single one of those lines. Or so that's one scenario. You don't understand those lines, and you're looking at a number on your brokerage account that is reflective of your buying power, not your actual liquid value of your account.
Can I throw something else out there?
Well, you
It
can
also, for a Fidelity, I'm going to pick on a Vanguard. Your fund, your emerging market fund, is up 27%. Or your SPY fund, one of the big ETFs out there, is up 20%. But when you close that position and create a taxable event, you find out that the SPY is backloaded, and that even though it's up 20%, you're going to net an 11% return.
okay.
Or the emerging growth fund that's up 27%. Well, your real return is only 13% because
Okay.
it's also backloaded. And it's just, Jeffrey, I'm frustrated today. I warned you this morning. I'm not going to
What
come
is
off as
what? Okay. So
professional as I
what is
could.
what does backloaded mean? Because I don't deal in funds. I don't do anything with funds. I occasionally play options on ETFs, and I occasion, everything else I do is in equities. What does it mean when it's backloaded?
So the SPY has taxes, fees, and distribution charges that occur when it sells off.
So
And
there's not
those
so
are being
okay.
backloaded, or as you sell your positions, you have a string of fees that are put into place that lower your return.
So what you're talking, okay, let me throw this. Tell me if I'm boiling this down to simplify. I'm simplifying this to my level of understanding. So I'm considering myself the lowest common denominator in terms of my level of understanding. So what you're saying is basically this. The S&P might be, I might have all my funds with Fidelity, Vanguard, Oppenheimer, whoever. I might have all my funds in the S&P. That's where I've put everything.
The SPY, correct?
The
Yeah,
SPY based on the little check boxes and the little I want this percentage in emerging markets, I want this percentage in large cap, I want this percentage, but I chose to put it all in the SPY. And the SPY from the time I chose to do that is up 20%. But what I'm not going to be told until the time of liquidation is the fees from the brokerage themselves that would actually make that a net gain of only 11 or 12% after they've taken everything that they're going to take. In other words, they're going to pull their piece of it. So when you say backloaded, you're talking, I thought when you said backloaded, somehow I was imagining something that, um, maybe they've got weird rules like a corporation does on when they can buy blocks and when they can sell blocks, and they might be locked in at certain prices that are not reflective of today's current price. That's not what you're talking about. You're talking about backloaded with all of the different fees they're going to charge you, which are going to make a 20% gain in the product look like only a 10 or 11, 12% net gain to you once they've pulled all their fees out. That's what you mean by
correct. So,
backloaded.
for example, most annuities are front loaded. You pay 7 to 9% up front. That's why you have to keep the money with that annuity for 7 years till those fees are recouped by the annuity. The
Because they're
problem
going
with
to
a
pay
front loaded fund,
because the person selling that annuity is going to get their big fat commission right up front out of that.
you got it. Well, and it protects the annuity position themselves because they will invest that usually into some tangible asset, some building, office building, whatever they choose. But the short answer is it's an insurance product that your 100,000 goes in as 91 and it grows over
Okay.
time. So then mutual funds said, well, people don't like that. They're not willing to be down out of the gates for safety and not to lose that 91,000. So we're going to put it in the back, which
So,
is
okay.
crooked because you see a big return, but when you cash it out, and I know there are going to be some out there that say, Kevin, you're so wrong, but you can just, for me, I go to E-Trade, I put the SPY, I get a quote, and there's a little box that says Morningstar, and you can click on the Morningstar report, and all the numbers are there. Everything's there that shows the 21.76 5-year average return or 2-year average return, nets after distributions and fees, you know, 12.76. And
Okay.
there's a
So
9%
so they
discrepancy there.
bury so they take those numbers and they bury them in there somewhere. They make it, it's like the fine print on any contract you sign. Anytime you click on something on the internet that says I accept these terms, but you haven't read all the fine print because it's a bunch of legal speak and it's pages worth of it and nobody ever reads it. So they're burying it in a place like that. And so
They're numbers. They're
when you
simple numbers.
but when you're talking about this lady that you had a conversation with that thinks she's up in her account and she's not, okay, so number one, it could be the fact that she doesn't understand things, how things are backloaded and doesn't know where to find those numbers or doesn't care to look for those numbers. Or the other thing you were alluding to is you might get some flowery report from your broker that says, here's our performance for the year. And they conveniently leave out the fact that anyone that cashes out is not going to get that amount because of those fees, because of all the other stuff. Or they
Or
don't
that if you weren't in that one position, you're not
or
going to
they don't
have those.
point out to you that you weren't in the one fund that did outperform and instead you were in some fund that did crappy and they're not highlighting that. Okay, I get it. I get it. I see where you're at. But it really is. So when you say it's about common sense, it's about a person taking the time and being aware of what they have, where they have it. And look, I don't know if it was your intention or not, Kevin, but you've made a great plug for why people should be looking for an independent broker, doesn't backload fees, that charges a flat percentage, that they're upfront about it, they're honest about it. They say, look, you're gonna look at this and think it's high, but if you figure out at some point that I don't backload, you're going to find that my fees are actually incredibly low relative to what you're going to get dinged with by these big box companies. And when people don't see all
One of the
that,
weirdest things I've seen right now. I had someone come to me for a guy out in Mississippi that is charging like 1.75 if you have less than 500,000. 500,000 to $1 million, he's charging 1.50, and over $1 million, he's going to charge you 1.25%. And someone said to me, "Boy, I really like that. And the more you have with them, the more, the cheaper it is." And I chuckled because I said, "Well, what about performance? Shouldn't performance matter to you? And why would you be okay with someone that obviously is going to show preferential treatment to those that have $1 million and charge them less than you by 0.5%? You're okay with already your broker giving preferential treatment to someone because they have more money?"
No, people need to
Well, I
get
don't know if you'll get preferential treatment. I said, it's right there. The numbers are right there. It's simple. Learn how to freaking add.
Well,
I'm shocked at people right now. I'm not having a good day.
all right. Well, listen, let's end on a good note.
So hopefully this is good entertainment.
Let's end on a positive note. In spite of some poor numbers, they were able, JP Morgan, Wells Fargo, they've been able to convince some people that things aren't as bad as it look and that things are on the uptick. The Dow's up 150 right now, NASDAQ up 112, S&P up 26. Let's hope that these gains hold today. Let's do this. Watch a positive market close, get a good night's sleep, and let's do this again tomorrow.
Yes, I'll pull my head out and I won't be so negative.
That's all right. Kevin, have a good one.
All right, you take care.
Okay, bye-bye.
Talk to you tomorrow.